On today's show, 3 questions. Number 1, what did the CPI show? Number 2, what is the unemployment rate? And number 3, do you hate paying taxes?
Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor.
Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. My name is Jake.
And I'm Rabih.
There we go, Rabih. What is up, everybody? Stoked to be here with you today. Matt is out on spring break today, same with all the other advisors, so it's just me and you. We're the only ones working, keeping the company afloat.
Dude, we have so much power right now. We can choose not to work and tumble this whole organization down.
It is great. We're happy people are enjoying their vacation. How about you, Rabih? How you feeling? How's your spring going?
It's good. Spring is good. I am enjoying that the weather got warmer, but I also have seasonal allergies. So it's a trade-off, like everything else in life.
I've never had to deal with allergies, luckily enough. So spring is nothing but good stuff for me. For those who listen or may know me, I'm a big golfer. And as we're recording this, and this will come out too during Masters weekend,
Yeah, true.
Which is a big deal. Always. Like we had, again, I'm a sport guy. We had March Madness a couple of weekends ago, but the Masters really is one of my favorite things there. I hope for people watching this, I hope that Jordan Spieth, or not watching or listening, either way, we're on YouTube now, so watching or listening. I hope that Jordan Spieth is in contention at some point, would be my hope, but I love the Masters. That's been awesome for me.
Are you also betting on the Masters like you do with March Madness?
No, not really.
Okay.
I just enjoy that one. Yeah, me and my buddies, we go do that fun kind of weekend watching March Madness. But I guess the Masters is just me just loving it, sitting back and watching. So that's what I'll be doing this weekend. Speaking of good news and kind of things that we're enjoying, the market's been awesome, right? This past week.
It has, but not because of its own merit, just because it was like overreacting a couple of weeks earlier and now it wanted to correct course.
Yeah.
Since March 31st, kinda, when the rumors about like the end of the war, or the truce, I would say, call it. It's not really an end of the war yet, but the truce started showing up. The markets have been recovering. What is noticeable is that the amount of insurance people were buying on their portfolios, measured through the VIX, has dropped below 20, and this is a very bullish sign for the markets.
Okay. Well, let's jump into it, Rabih. Our first question that we wanted to tackle today, hand it over to you, is what did the CPI data show? Where are we at?
So this was very fascinating because this is the first inflation report we get post the beginning of the war, beginning of March, right? And with the oil spiking, we were worried that this is going to cause like a trickle down effect. It might really, make us remember 2022 with the Russia-Ukraine war. And we actually got the data. So the broad CPI, that number that you see on the news, that same number that a couple of years ago reached 9.1, right? Inflation. In February, and honestly between like November till February, it was hovering in like the 2.5, 2.7 range, right? Which is under control. It's not 2%, but it's clearly close, like job almost done. But with this one print of inflation numbers, that number jumped from the 2.4 all the way to 3.3. So prices overall since last year till today are up 3.3%. Not the greatest news. But if we zoom in and we start looking at this data in terms of the categories it covers, there are 3 main categories. There's the inflation related to food, there's the inflation related to energy costs, and there's the inflation related to everything else. So all inflation excluding food and energy costs. And the reason they do this breakdown is because food is not really, controlled by economics and interest rates and inflation. Food is controlled by supply and demand and the seasons and how crops would do well. And oil is, as we have learned really well this month, is controlled by production, supply, and supply chains, and whether these supply chains are disrupted. So that's why they try to look at inflation without these two. So when it comes to food, while food slightly increased, it's not as bad. We were in the 1.9 2% range, and we are still in the 1.9. So although food increased, it's very minimal so far. the elephant in the room is energy. And energy back in August and like November and December and even January was flat, like from one year to another. And you guys remember, we were filling our gas tanks at 2.3, 2.4.
Yeah.
It was super cheap. There has been, from this March to the previous March, a 12.5% increase in the price of oil. It's like, if you look at the graph, it's nothing but a straight line up, going from the 0 level to the 12.5 level. Hopefully, that does not start carrying over into other stuff. We saw it slightly in food, but nothing remaining. In terms of inflation for all the other categories, so all items less than food and energy, we kind of moved from a 2.4 to a 2.6, but in January it was 2.6. We're flat. So right now, inflation report is telling us that everything is still contained with energy. But consumer sentiment came up also this morning, and it shows that the consumers are sad.
Okay, this is what I wanted to talk about, because Rabih,
Yes.
I'm glad we're talking about this, because I think the number one thing I'm hearing just anecdotally in my life with the people I'm talking to is, oh my goodness, prices of everything are going up. Oil especially, right? When I go on and go to the gas tank and fill up my car, the prices are outrageous. This sucks. Everything sucks. Prices are going up. So we are seeing that, right? In the general CPI data, going from that, mid 2% up to 3.1% is reflecting that since the war. But it really is oil, gas more than anything, right? Is what you're saying
So far,
there?
it's oil and gas. Yes,
Yeah.
100%.
Which does that trickle and affect everything, right? That's like essentially, does that, figure into food transportation costs and airline flights and all these different things, and it causes just companies to increase their prices across the board because the cost of oil goes up. Is that correct to say?
100%. So the fact that oil increased it on its own, as that statement on its own is not supposed to say, oh, now we're going to face inflation across the whole economy. However, if oil stays elevated as much and now it's normalized and it's part of every company's income statement, and this is an expense that they put in, and they start thinking of it as a new reality rather than a one-time spike, then you would start expecting that prices across the board for every item, for every service that now is more expensive because oil got expensive, to reflect that increase. And here's where the risk is. It's slightly hitting into the political aspect of it.
Yeah.
Where they've announced a truce, right? They're not bombing Iran for 2 weeks. They're negotiating. However, the Strait of Hormuz is still blocked, and the price of oil is still at 100. It hasn't dropped. Ending the fight, which is great because no more lives lost on either side. We want that. Does not mean that economic implications are not going to go away. But it seems more than likely that the ticker for the price of oil is one of the cards they use on the negotiation table. So they're not going to let go of that as quickly or as easily. So how long does oil stay up? That will determine it. But as long as oil stays up, the more, as you mentioned, Jake, our perception of it and our psyche will change. It's actually very interesting because the consumer confidence index is like it's like a thermometer, and every time it's above 50, which has been above 50 for like the last 55 years, not 50 years, for the last 5 years, except in like small episodes of like COVID and the war in Ukraine, it's always been above 50. The US consumers never fail to be confident that they're going to spend their way out of their problems. And this was a reading of 47, not really below 50 by much. We average around like 58, 60. We dropped from that to 47. It is below the 50. We kind of, Jake, where we need you to hype the consumers back up. This is what we want
this
from
is
you.
interesting. I mean, that makes sense to me. Just again, anecdotally from people I'm talking to, most people are like, oh man, this economy stinks. We're in a really bad spot. The prices of the things I'm buying is going up. There's a war going on that I'm not sure why it's happening or when the end is going to be. I see a lot of pessimism right around things, which I get. I mean, the optimistic point of view, it leads into my next question that I wanted to go to. We might as well just hit that now. The optimistic way to look at this would be everyone still has a job, or pretty much most people that want a job have one. So let's get into some unemployment data here, looking at the current unemployment rate. So right now, the most recent data we have for unemployment is we're sitting at about 4.3% unemployment in the United States. And we've been hovering, right, Rabih, around 4 for a while now. what I find interesting is not just that 4% rate, but if we take this in a historical context of like how low this unemployment has been for. From March of 1965, we're going to get into some numbers here. From March of 1965, so we're going back quite a ways, until July of 1970, so about 5 years there, the unemployment rate was below 5% every single month for that stretch of time. That was the longest streak on record in American history, that 5 years. Currently, we are now sitting, if we exclude COVID, okay, and I know that's, some people may say it's a big caveat, but there's a really big spike in unemployment.
It's a blip in the data.
I feel like that's fine. Every chart that you look at with COVID is always a weird blip thing. If we just take that out to normalize things, unemployment has been below 5% since 2015.
Which is, incredible, because the long-term average of unemployment is in the 6% level.
Yep. You're right there. So we've been below 5% for over 10 years now. Every consecutive month, we're sitting around 4% now, which is, this is probably one of the longest bull economic booms that we've had in American history, right? We've seen it with stocks and just the economy. And I think, yes, this is tying it back into our previous point of, well, I know everyone complains about inflation and higher gas prices and things like that, but we really have been able to spend our way through a lot of these ups and downs over the past 10 years. Mainly, I think a big driver is because everyone has a job. I think people, when they have a job and they know a paycheck is coming in every 2 weeks or every month or however you get paid, even though prices increase and it's fun for us to complain with each other about it, we're still like, you know what, I'm just going to suck it up and I'm still going to go fill up my car with gas. I'm still going to go on vacation and do the things I want to do and buy the clothes that I want because I know a paycheck's coming and I'm going to figure it out later. So I guess that would be the optimistic angle of everyone's being pessimistic about things, but we're not really seeing a ton of job loss, Rabih, as of yet. Do you think that changes in the future? If you have a crystal ball and wanted to look over the near, let's say, year to 2 years, do you think we break this unemployment streak soon, or where's your head at?
My head at is there is slightly something more underlying. Yeah, it is positive that a lot of people are not getting fired. Yeah. But also what we're seeing is that not a lot of jobs are being created. That is why it's stable. But something that is very interesting to look at, Jake, is if we take a step back and we're starting to reassess whether unemployment rate is the right indicator, because here's how the US does it. The US takes the whole population, the 350 million where we live here, and then says, okay, who are between the ages, I'm not sure if it's 16 or 18, but who's between the ages of 18 and 16 up to 65, who are not active in the military, those we're going to consider them the labor force. So out of the whole population, this is the labor force. Actually, that labor force is around 165 million people. So almost half of the country is not even part of the labor force. It's the kids and it's the older people, right? But then what they do, how they calculate the unemployment rate, is that they look at this labor force of 165 million people and they go see how many of them are employed. So if you are part of these 165 and you don't have a job and you're searching for a job, then you're going to be part of the 4% unemployment rate. But if you're part of that labor force, but you say, I don't want to have a job, the stock market has done really well for me, I'm on a FIRE movement, I decided to retire early,
or I have my parents' money, I don't need to work here, I'm going off the grid.
Because Americans are the richest they've ever been. The average Americans, the richest they've ever been. You could say, well, yeah, although on paper I'm in the criteria that falls into what should be considered in the labor force, I don't want to search for a job. So in that sense, they don't count you out of the people who are unemployed. What has happening is that you look at the participation in the labor force, aka this whole labor force, how many of them are participating? And the ones participating are the ones who are employed or unemployed but want to work, not saying I don't want to work. And that participation rate has been dropping, and it has been dropping a lot. So just to give you a sense, between the year 2000 until 2008, the participation rate has been around 66%. So 66% of the labor force choose to work. Some of them are employed, some of them are not employed. The unemployed is the unemployment rate. And then between 2010 and 2009, or between 2010 and 2015, it dropped to 62%. It was a steep drop, but 2015 till 2020, flat at 62, 63. So this is the number that we have in mind. Between 66% to 63% is how much people participate in the labor force. COVID happened. It's a blip as usual. It's recovered by September 2023. We were back to the 62%. But since then, it's been dropping. And the last reading, which we also got this week for the labor force participation rate, is only 61.9%. So another reason for why the unemployment rate has been stable, not only because not a lot of people are losing jobs and not a lot of jobs are being created, a lot of people are choosing not to be workers anymore. So
that's helpful context, right? Kind of diving deeper into those numbers there. I do think we've seen this trend too, Rabih, or I think you've mentioned it on this podcast before, which is like, I think like there's a difference between the haves and the have-nots, right? Especially with jobs, where I think no one's really getting fired. We're not losing a ton of jobs, but the people who are entering the workforce and wanting to create new jobs are having a hard time finding a job, right? So it's like if you have a job, you feel great, and a lot of people are losing the job that they do have voluntarily or involuntarily, excuse me. But maybe the people who are outside of the workforce, like you said, wanting to get in, that participation rate number is going down.
It's going down. Not a lot of people actually want to work. This is not healthy in the broader image, but it keeps the unemployment rate flat.
Interesting. Yep, that's very interesting there. Causes for that participation rate, is that just a weird thinking? I know a lot of are we blaming AI for this? If you had to give some guesses.
It could be AI. It could be the fact that the Americans are the richest possible. But I think the main hypothesis is a big chunk of our demographic are baby boomers who are deciding to retire early. This is what I think it is. I don't
think the companies' earnings are still strong, right? Like companies' earnings are still going up. Companies are making more money. They're just feeling less of a need to hire people.
Like the boomers are sitting on a big amount of wealth. They can afford to retire early. Companies are not incentivized to fill their spots as fast, given that they can make capital investments in AI. This is the reality.
Okay. So a little double-edged sword there. We gave you a positive outlook and a non-positive outlook. Kind of circling back, one thing just like from a personal finance view as an advisor, that's where my mind always goes to people's personal budgets. If you are still on the pessimistic end of this and you're complaining a lot about filling up your car with gas, I get that and I hear you, and it sucks. We never want to see our prices, the things that we buy, the prices to go up. It's terrible. We all hate inflation. I think of all the things that I think we're divided on in this country, inflation is one that we're all unified that we hate, right? We just hate that things cost more money. I would say this though, just as a point here, this is maybe a bit of an aside. If his gas is going up by, let's say $1.50, whatever each gallon is going up by, unless you drive a ton, it should not materially impact your personal budget all that much, is something I would say. And if it is, like, let's say your gas, like you drive, you fill up your tank 2 to 3 times a month, gas is $1 more per gallon than what we've been used to. You're increasing your monthly expenses by, let's say, $40 to $50, let's say, in gas on the high end. Like if you're really driving a lot and filling up 3 times a month, that stinks. That's never fun to have your household expenses go up. But what I would just say is, if you're preparing financially, a $40 to $50 increase in your monthly budget should not wreck your budget. At least I would hope not. Okay.
Yes.
That like you need to have some flexible room in your budget, that these things are going to happen. I actually wrote an article a couple of weeks ago that outside of this Iran war and oil prices and gas increasing, we see gas prices fluctuate throughout the year, almost every year, just naturally. Like summer gets a little bit more expensive, winter it gets cheaper. You'll see a 50-cent price move in most years, actually. And so like gas prices going up and down is going to happen in most years, and you're just gonna have to spend $10 more 1 month or $20 more 1 month unless. And I just think like, yes, it's something we can complain about and talk to our friends about. And I think complaining actually, it can unify us as a people. Sometimes we complain together and it bonds us. But from like a macro point of view, like with your retirement in mind, wealth building and saving, gas prices going up really should not have a long-term impact on any of that. I get it's like a sticking point. But like where we are now, again, we'll see what happens in the future and where oil prices and things go. But like spending $40 or $50 more at the pump should not wreck your budget. You should, if you're planning things properly, should have the room to accommodate that. Anyway, I just wanted to get that off my chest.
But no, I agree. And if it does, because for some people it does, right?
Yes.
And it's a very easy, low-hanging fruit to fix, to pick and to catch, because dentists are high earners, and it would be nothing but step in organization. We've got a full team at Dens Advisors. It's collecting your data, it's organizing your data, and is able to immediately find those low-hanging fruits where budget constraints become something of the past. And we start looking at bigger goals, such as helping you with your practice, or helping you retire early, or helping you set money aside for all the goals that you want with your life. And this is what the advisors are doing, which is what I'm doing, what the rest of the team is doing. So if it is, it shouldn't be. But the good news is dentists come up from a high earning demographic and should be a very easy problem to fix.
There we go. Way to give a plug for us there. I'll say one more thing too. If you're driving a big truck in diesel and diesel's worse out there, listen, you may not like this, but do you need the truck would be the question that I would ask. Do you need the truck to drive around? Maybe a more fuel efficient vehicle is possible. Rabih, do you think that this spike in gas is going to push more EV vehicle sales? That we're going to get more electric cars? I'm wondering if this is a downstream effect of higher gas rises.
Maybe some people would say, oh, well, my car is hybrid, I don't have to worry about it. But man, I do have a hot take on EVs. Do you want to allow a minute or two for that?
This is our podcast. We don't have anyone checking us. Let's do it.
Okay. So here's the thing with EVs. Supposedly, when you buy an EV car, you do not have to worry on car mileage, the mileage on the car, and it's supposed to be also environmentally healthier, between quotations, because it harms the economy a lot to produce these batteries. But what I've been noticing is, I was reading all this research about how EV cars are supposed to replace diesel generated cars. This is happening globally. The only place where it's not happening is in the US. So actually, because I was on a journey of buying a new car, as you guys have, I did not buy an EV or a hybrid car. I just bought a traditional car in the US. But what happens is that if you look at EVs across the world, especially in very dominant markets where EV is thriving, such as in Europe and in China, the average EV car is around 10 to 15K. Whereas EV cars
the price
in the US,
the price.
Yeah, the price of them. They are cheap. It's definitely, for a US consumer, they're cheaper than usual. But a 10 to a 15 car for a consumer in China is not the same as what EV cars are over here. EV cars in the US are sold at a premium to gas cars, whereas in the rest of the world, EV cars are usually the cheaper option compared to gas cars. This is the claim that I wanted to make. So yes, in general, outside the US, where there are lobbies, there are gateways to prevent EV cars from taking out market share, etc. A higher increase in oil prices should economically lead to people shifting to these more efficient and cheaper cars. It should on textbook. But the US has kind of built up fences regarding to its car trades. You guys know all the cars that we see are either American, right? Either European or either Japanese and Korean, but with quotas. And that's why there is, Lexus and Toyota are the same company. Nissan and Infiniti are the same company. Honda and what was the other one? Acura are the same company. The only reason we have two brands in the US, which you do not see outside the US, is the fact that the US has imposed fences, imposed quotas. So these foreign companies were like, do you know what? We're going to create a luxury brand and a commercial brand and sell both so we can hit the quota twice instead of once for these. So I 100% agree with what you're saying. The economics should mean higher oil prices, people move to the efficient car. Because the US has an intervention in the middle trying to control the market share of cars within the US, I don't think we're going to be seeing that shift as fast as we think we would. So it's not a trade. You can't trade on EVs in the US. This is my hot take.
I like it. I think that's a great point. We're doing a little car corner here. It is funny too when you're thinking about this from a personal budget, personal finance point of view. If you want to get into an electric car, that sounds appealing to you. You're saving money on gas. But it's this electric car is costing $20,000 more than the other car that I would have bought. Well, for $20,000, that buys a lot of years of gas.
100%.
Kind of the issue where it's
100%.
that could cover your gas for the next 10 to 15 years there. So it's an interesting trade-off. Yeah, just what's actually more cost efficient for you to drive around in. Anyway, okay, good car corner there. Let's hit on Let's hit on our third topic here. I'm continuing. This is just on brand for me. Continuing talking about people complaining about things. Let's talk about taxes.
Yep.
It is technically like tax week when this podcast comes out. April 15th is the tax deadline for 2025. Some of you may have extended your tax returns until October. I get that. That happens with a lot of our clients. But I just want to talk about taxes. Maybe a controversial thing I'm saying. Not really. Like, I just want to give some broad education around taxes.
Did you file your taxes, by the way, yet? Are you one of the early filers?
Yes, you know me.
Okay.
I'm the first day, which is usually early April, end of January. I file my taxes and I get it done.
Nice.
Which I like. That's just me. I want to get it done, get out of the way, and not have to think about it. What about you, Rabih? Are your taxes done for 2025?
Yeah, I did. We had an episode. I don't know if you were aware, but I wanted to time it perfectly, and I only had to pay $24 for the Fed and $1 to the state of Utah. They ACH'd me. They charged me $1. I'm not over it.
Incredible. Yeah, you threaded that needle perfectly. Perfect withholdings for what you were going to owe. You didn't have to give the free loan to the government that people talk about, all of that good stuff. Okay, just some quick things on taxes here. Surveys show that 60% of Americans think they pay too much in taxes, which I actually find shocking. I thought that'd be like 99%. People think they pay too much in taxes. So they show 60% reported they think they pay too much. I think, again, speaking of inflation, what do you think people hate more, inflation or taxes?
Taxes. Inflation happens everywhere. I don't even hesitate with that question.
Yeah.
I think people hate taxes the most.
We really do hate taxes. And
let's
I'm okay
remember
with
that the story of this country was about taxes.
It was about people just saying, you know what, I don't want to pay this tax. And it wasn't even a huge tax, right? And they just said, I don't want to pay this. Yeah, so that's in our blood here in America, is we really don't like paying taxes. That truly is something that unifies us all, I think. But what I wanted to get through is I think there's a healthy hate for taxes we can talk about, right? Okay, you don't like paying taxes, that's fine. I think it can go overboard. We talk to people all the time who they wake up thinking about taxes, they go to bed thinking about taxes, and every decision in their life, every wealth decision, every savings, investment decision is built around how can I save on taxes. And I think if you're on that spectrum, you maybe need to take a look in the mirror and reevaluate some things, okay? So I think people hate taxes more than they should, would be my take here. And I think we often hate taxes because we don't understand them completely, would be my take. We don't understand how our tax system works. So let's start with the basics. Again, if you're listening to this, you may think, oh, this is obvious. But I don't know. In my experience, a lot of people don't quite understand how the U.S. tax system works, right? So we have a progressive tax system, for those who do not know, which meaning they're like tax brackets. It's just a fancy way of saying, like, as your income increases, you will get into more higher tax brackets and end up paying more taxes. So our current tax brackets, we'll just do 2026 here. We have 7 tax brackets, if you didn't know. Starts at 10%, then we go up to 12%, then 22, 24, jump up to 32, 35, and 37. Okay, those are the 7 tax brackets we have in America. That doesn't include state. Those are just federal income taxes that you pay. The highest bracket to get you in, if you're married filing jointly, the top bracket, 37%, is people who make $750,000 combined or more. If you're single, it's $626,000 is what gets you in the highest bracket. Anyway, we have progressive tax bracket system. I just wanted to outline that there. So here's what's important to understand about taxes is you'll get into these different tax brackets. Just because you're in a tax bracket does not mean that you pay taxes that rate on all of your money. For example, let's say you're a single filer. You make $100,000 in taxes, okay, in 2025. That puts you in a 22% marginal tax bracket. So most people think, oh, I'm paying 22% of taxes. That really stinks. You're not paying 22%, okay? So you pay 10% on the first, let's say $12,000 is about what it is. Then you pay 12% on your income between $12,000 and $48,000. And then from 48 to 100, you're paying 22%, right? So in all, you pay about nearly $17,000 in taxes if you're a single filer making $100,000. So you're in the 22% tax bracket, but you're only paying about 17% of your income toward taxes, right? That 22% is called your marginal tax bracket. The 17 is what we call your effective tax rate, like what you're effectively paying towards the government. I think that's important to understand. Okay, just get that out of the way. Basic education. They should teach us that in schools. I don't think they do, or people forget about it. Important to understand that tax-wise, because you'll hear on numerous occasions, Robbie, people say, well, I don't necessarily want to make more money this year because I'm going from the 24 to the 32% marginal tax bracket, and I just don't want to do that. This is flawed thinking. Okay. If you want more money in your pocket, you always want to make more money. There is never a point in our whole tax system where making an extra dollar is not worth it. Okay.
100%.
Can I get that
What
clear?
is the top marginal rate?
37.
37. So
Yep.
no matter how much money you make, every additional dollar you produce is only going to get 37 cents taxed out of it. So you're always going to have more in your pocket than you pay in your taxes for every dollar.
63% of something is better than 100% of nothing, right? It's kind of the way to think about it. So it's like you're getting 63. Now, again, if you add in state taxes and you live in California, you're getting up into the mid 40s. I get it, right? You're getting close to that 50-50 line. But still, it is always better to make that additional dollar. This is like one of those things too, along those lines. Okay. If you owe a lot in taxes this year, it's a bummer, but it is also kind of a grateful situation to be in. Like, you're in the unfortunate position to be in, where if you're paying a lot of taxes, what that usually means is you are making a lot of money, right? Someone who makes $50,000 and pays like $2,000 in taxes would gladly trade places with someone who makes $500,000 and pays $200,000 in taxes, right? Even though that tax bill is like 200 times what they're paying, the net take home is still so much more. Everyone would always trade places with someone who's making more, because your net take home, even if you're paying more in taxes, is going to be more. Now, listen, I think one of the smartest things that the government or the IRS ever did is they kind of made taxes for most W-2 workers. They take taxes out of our paychecks, really smart, where people sometimes don't even look at their gross paycheck. They'll just look at their net. This is what I take home. This is how much I make. They don't even look at the tax line, right? The federal, the state, and the payroll tax. Don't even look at it. So it's kind of out of sight, out of mind. And then most of America will get to tax season and they may get a refund back and they think it's all good. For a lot of our clients who are business owners, I sympathize with you, where it is not that way, where the majority of your income is not coming through a W-2 paycheck, but it is just coming in to your business operating account. You are seeing the money, and then so you're getting the money and then you have to pay taxes later. I think that friction of getting the money and then have to pay it back causes a lot of the tension and stress, where it's like, man, I had this $30,000. It was sitting in my bank account, and now this quarter I have to pay it back to the IRS. That hurts a lot more than just having it taken out of your paycheck. And so, but a lot of the people we work with, I see that, like, that tension there. And I get that of like seeing the money in your account and then having to pay it really hurts. And so it's like, whatever we can do to lower taxes, let's do so. I'm going to go off on deductions here, Robbie. Is there anything you want to add in before I go here?
No, I love it. It's really good to remember the basics.
Okay. So let's talk about deductions, though, along with those. This is for a lot of the people that we work with is how those works. Again, maybe this doesn't need to be said, but I'm going to say it anyway. If something is tax deductible, it means you'll be able to deduct that cost from your income, right? This provides a small tax break, but it does not make the purchase free, okay? Can I say that again? Deduction does not mean free. So let's say you get to the end of the year, you owe a lot of taxes, and you're like, man, I want to buy a truck to lower my taxes here. And this Ford F-150, or let's say like a Ford 350. Let's just go all out. Ford 350, huge truck. It's awesome. I've been wanting it. I'm going to buy this $100,000 truck to help save on taxes. Let's say you're in the 32% marginal tax bracket, right, that you pay. So you're saving $32,000 in taxes by purchasing this truck and putting it on your business, which is a whole different thing to get into. Again, like the viability of putting a vehicle on your business is something it needs to be used for business use. I don't want to get into all that, but let's say you can deduct it. This $100,000 expense, you're saving $32,000 of taxes. That's great. But you're still spending $68,000 extra dollars on that truck, right? Well, even though you're getting a 32% discount, still, like, you're getting 32% off, it's 68% on. Okay? And so if you're just like, how do I keep the most money in my pocket? It would be just to pay the taxes and not buy the truck. Okay. I know that's kind of a radical idea to hear here, right? A lot of tax strategies involve giving your money away, right? Where it's like, okay, I can lower my taxes by giving to charity, right? If there's a church I really like, I can give money there and lower my tax burden. Or maybe I can buy a piece of equipment for my business or do something like I can give my money away to lower my tax burden. In pretty much every case, if you just want the most money in your pocket, it's just to pay the taxes and keep your money, right? Where it's like, let's use like this a simple example. Let's say you have $5,000 that you want to give to charity, and you save like 20% right on that $5,000. What's my math there? 20% of 5. What is that, Rabih? $1,000.
20% of 5 is
so you're saving $1,000 in taxes, right? If you're in like the 20% bracket there. So in this scenario, it's like, yeah, I saved $1,000 on taxes, but I'm net negative $4,000, right, in this transaction by donating. If I just wanted the most money in my pocket, I would have paid the taxes and not made the donation. Now, this is me not discouraging you from charitable giving. I think it's a great thing, and giving your money away is awesome. If you already need it, do it and get the tax break from it. But oftentimes, doing something just for the tax deduction does not make a lot of sense. One last thing here. One tax deduction I think gets overlooked, which is really awesome. Retirement plans and 401ks are incredible. They are actually pretty much the only place where if you put your money in a 401k, you get a tax deduction and you get to keep the money. So you're not giving it away. You don't have to buy something. You get to keep the money in an account that is owned by you and get the tax deduction. I get 401ks can sometimes be boring or really basic, but for my money, I think they're like the best tax strategy option out there. So I'm pro 401ks. They're awesome. I'm rambling here, Rabih. The people are probably sick of me. Anything to add on my general tax rant here?
No, I love it. And it just tells you that everyone thinks about all the loopholes that exist in the tax code, but usually if you shift your attention to the tax code itself and not try to find its loopholes, the tax code is there and is concrete and it's cohesive. So focus on the stuff that matters, then something that does not go away. I agree with you. Probably most of the time, the cheapest way or not the cheapest, I wouldn't say the cheapest way, but the way that preserves most money in your pocket is to pay the taxes rather than to have decisions be controlled by the fact that you want to avoid these taxes. We see it over and over from my perspective in investments where people are like, I want to reduce more taxes on this. I want to tax loss harvest more. It's like tax loss harvesting only happens when you're losing money. Are we actively trying to lose money? We will gladly tax loss harvest when the market goes in directions we do not expect, because this is part of the risk of the market. But to actively go and search for tax loss harvesting opportunities would be actively burning money so you can write it off.
Or I see this sometimes, Robbie, with capital gains, we'll see, right? Where people have, like, they'll buy a stock and it has a lot of gains in it, which is awesome. That's like the whole reason you got into the stock. And then sometimes they won't want to sell their winner because it's like, oh, I'm going to have this big capital gains tax bill that I don't want to pay. And I'm going to hold on to it maybe for too long until it goes down, or they don't want to liquidate and access that money because they don't want to pay taxes. And it's like, the reason you bought this stock in the first place was to have it grow and paying capital gains tax. Paying capital gains tax is good. That means you had a winning position, right? That means that your positions went up and you'll want to pay it. And so, yeah, our whole thing is don't let the tax tail wag the decision-making dog, right? Anything there. I would say this, like, no one has ever built meaningful wealth in America without paying taxes. It's okay. You're not going to die. We all have to pay some sort of tax. Again, we want it to be lower within a reasonable amount. Let's lower your tax burden as much as possible. But at the end of the day, I think it's something we shouldn't get too worked up over, would be my hot take. And if people want to come at me, please let us know. If you're like, oh, this Jake guy is way wrong, he loves paying taxes. I don't love paying taxes. I just think we think about it too much and let it influence our lives too much, right? Texas has no state tax, the state of Texas. That doesn't mean we should all uproot our lives to move to Texas, right? There's a lot of other things in life that should impact our decision-making other than just what is the tax consequence of doing so. Okay, I'll end my rant there, Rabih.
No, I love it. I think I appreciate the tough love. I think all the others will appreciate the tough love.
Some people may not appreciate it, and that's okay. I'm okay with that pushback there. Okay, Rabih, let's get kind of to the end here. We'll keep this one shorter for people this weekend so they can get back to watching golf and enjoying the good weather. If you want more of these tax rants from me, I might be doing something like this at the summit, or maybe I'm not going to get on stage, but we have our Dentist Money Summit coming up here in June. It starts on June 11th. It's a really awesome event. We'd love if anyone wants to attend. We would love to see you. Great education. Again, if you hate like my tax rant that I just want to hear, you can come up to me in person and tell me I'm wrong, and we'd have an awesome discussion. It'd be really fun. Bobby's going to share free stock tips for you there as well. Just kidding. That's a joke. For compliance reasons, that is a joke. But please come. The summit's going to be awesome. So if you just want to talk about your own personal finance situation, if you want to talk about your personal budget and investing and retirement numbers and insurance or student loans or anything that's top of mind or stressing you out, we would love to talk to you. We have awesome advisors at Dentist Advisors. If you go to our website, dentistadvisors.com, there is a yellow book a free consultation button. We promise we are not pushy. We are not salesy. We would just love to talk to you about your situation. Go on there, book a time with one of us, and we'll have a great discussion. Anything else, Rabih, before we leave here?
I love it. I want to see whether Matt will feel jealous when he listens to us.
Hopefully Matt is jealous of this. If you're listening, Matt, we'll be happy to have you back next week. Okay, everybody, thank you all for listening. That is our 2 cents, and we will see you next week.